Even Apollo noted in their last investor update in December that the regulatory arbitrage represents the most serious threat to the financial system. If you take a portfolio of 1 billion in assets that are rated, say, single A minus, the capital requirement on this book will be about 1% or 10 million of equity that an insurer will need to hold. Now imagine that this book is downgraded by 3 notches to triple B minus. The amount of capital to be held would more than double to $22 million. Imagine a downgrade to double B minus. At that level, the capital requirement stands at 6%. So we haven't had any defaults yet, but the capital requirement has increased 6-fold.
Welcome to another episode of Fixed and Floating. My name is Josef Pschorn, and in each episode we explore the forces shaping credit markets. Today's episode was inspired by a podcast. Not this podcast, a different podcast talking about the intersection of life insurance and private credit. One that Jakub and I listened to, looked at each other, over WhatsApp, and agreed it contained some ideas that were, let's say, creative. Specifically, the idea that an institutional investor could just call up Apollo and ask for $3 billion back, and that this could start a run on a life insurer. It's a very vivid image, but it's also not really how life insurance works. To help separate the noise from what's actually going on, I've brought back the one person I trust to do exactly that. Jakub Lichwa, friend and portfolio manager at TwentyFour Asset Management. Jakub, welcome back.
Thanks for having me, Joseph. Once again, talking about life insurers feels like a deja vu, but had to be done.
There's been a relentless stream of negative headlines at the intersection of life insurance and private credit. Most of it focused on the US. Before we get into the mechanics, I want to get your honest read. Is the market getting this broadly right, or are we in the middle of a genuine misinformation cycle?
Yeah, as you say, the amount of negative headlines has been honestly relentless. Life insurance firms have found themselves at the crosshairs of it because they have extended into private credit markets in the recent years, especially in the US and to a lesser extent in Europe. The amount of negative news flow has been worsened by the disinformation we are seeing in the space. As you mentioned, just a week ago, we talked about the podcast by Steve Eisman on this very topic, on the life insurance topic. His guest there said that there is a risk Vanguard or any other large bond institutional investor could call up the CEO of Apollo and ask for $3 billion parked in funding agreements at any time. And this could spark other institutional investors to make the same calls, which would effectively start a run on the life insurance. Now, that's not exactly how it works. Funding agreements, we'll go into more detail later, but funding agreements act more like bonds rather than demand deposits. There are no acceleration clauses in these bonds. Nobody is calling anybody, and you get paid on the stated maturity date. If we start calling all issuers whenever we get nervous about spreads ahead of the stated maturity date, will be in all sorts of problems, and funding agreements will be the least of our worries. So basically, this was just a colorful characterization and somewhat inaccurate. But just to be clear, it's not just about this particular example and this particular comment. Private equity ownership is often inherently viewed as leading to inferior outcomes for policyholders. Offshore reinsurance is viewed as having effectively no oversight or supervision. Now, don't get me wrong, there are risks related to the life insurance space and private equity credit. For once, private credit has expanded exponentially in the last few years, and now, by some estimates, accounts for about a third of US life insurance assets that sit at about $6 trillion. Second, the growth in the usage of offshore reinsurance has also been exponential. Whenever you see growth of that magnitude, some risks can creep up, even if they are not obvious for the moment. And finally, policyholder behavior is a question mark. So far, we haven't seen red flags over there, but that can change. News flow can turn, and we can see, again, surrender rates spiking. But the general message appears to me to be more nuanced than what the headlines are portraying, and often misses the important mechanics that are so relevant to understand the dynamics here.
Let's build the foundation before we stress test it. Walk us through the main US life insurance products, specifically the ones where private credit becomes relevant. I know you want to draw the distinction between protection-orientated and spread-based products because the asset demand looks completely different depending on which side of that line you're on.
Yes, let's start to draw the picture for the US life insurance space first, because as you say, I think it is quite important to understand fully the dynamics which happen in the space. In the previous episode, we touched briefly on the very basics of insurance products, and we gave some examples. We talked about someone wanting to insure against their death, or in other case, someone paying a lump sum in order to obtain a string of payments, annuities, which they can use during their retirement. I want to take this a step further and apply to the US life market. Again, I think that is important because it's relevant how those products differ, say, versus European space, where annuities and life insurance products tend to have longer duration, which in turn has implications for the demand, for the type of assets that are demanded by these companies. So back alluding to your point, talking about the US lifers, the space can be broadly split into protection-oriented and spread-based products. Protection-oriented products, some examples are term life, whole life, guaranteed universal life. In all these products, the insurer makes money by correctly estimating the lifespan of a policyholder and by controlling its own costs. Now, they are not taking a lot of investment risk in the process. The investment profile tends to be conservative and it supplements the underwriting profitability. That is different from spread-based products. These are either fixed annuities or fixed index annuities. In fixed annuities, very popular product is the multi-year guarantee annuities. The life insurer offers a full principal protection and a declared guaranteed rate. In fixed index annuities, a policyholder receives a full principal protection and a payout which is linked to some index, for instance, S&P 500. Economically, you pay a lump sum and the insurer invests that premium in a bond portfolio that has a yield just higher than what the policy promises to pay you out.
So what you're saying is that the insurer takes a kind of spread risk, whereas he has some liabilities in the futures and need to match that with assets. And I think that's the point where private credit plugs perfectly in. Why would you say that the liquidity premium that private assets and private credit has, and which sounds like a disadvantage in most contexts, is actually becoming a feature that life insurers actually desire?
So in short, if I had to summarize it in one line, I would say that private credit can offer attractive illiquidity premium to back stable annuities/liabilities that actually do not need to be invested in liquid assets. And I think some historical perspective can be helpful here. Prior to 1980s, there was a strong demand for protection-oriented products from a working age young population in the US. Median age at the time was about 30 years old. As we moved to 1980s, the interest rates have increased. This created strong demand from customers to lock in those rates for longer. Annuities market exploded in popularity. Fast forward to 2008, and the rates were clearly on the way down. This put pressure on many annuity books. Life insurance equities and companies were especially under pressure between 2010 2015. We have seen spread compression, reduced demand for annuities, reinvestment risk rising. This created an opportunity for buyouts in the space, and that's where private equity firms stepped in. They were able to supply life insurers with the higher yielding assets. And this model has also received a boost post the global financial crisis because of the tighter regulation of the banking sector, which again, the private credit operators were able to exploit. And finally, the most recent tailwind that this space received was in 2022. Once again, as the interest rates were rising, the demand for annuities increased, and this also coincides with the rapidly aging society in the US. Right now, the median age is closer to 39 years.
Just to get this straight, insurers benefit from their longer liabilities, whereas banks which have way shorter liabilities, so that the natural home for private credit and illiquid assets is much more suited for insurers versus banks. You just mentioned that yields have been creeping up over the last couple of years. I mean, those higher rates should help pretty much all insurers across the board, not only private equity owned. So what is specifically about the private equity model which is creating an additional edge here? Because the virtuous flywheel you described in episode 3 seems to go beyond yield pickup.
First, let's start with why the annuities are needed and how they operate. A person in the US saves differently than a person in Europe. In some European countries, people use life insurance products to save throughout their working career, whilst in the US, people normally save through 401k and then use tax-efficient life insurance policies to decrease the volatility during their retirement. So more specifically, a person in the US would have accumulated their 401k or defined contribution pension during the working career. This would be invested in mutual funds, both bonds and equities. And as the person turns 65, retires, they may wish to lock in the value of this pension pot and reduce its volatility whilst continuing to invest. They have a few options. They can clearly put it to a bank as a deposit, they can put it to a money market, or they can buy an annuity from a life insurer with a strong credit rating. Life annuities sold by private equity linked insurers tend to have typical duration of 3 to 10 years. The interest is often rolled up or accumulated as opposed to being paid out. This allows for a better tax efficiency and gains to accrue value without having to pay the taxes every year on the interest. And the policy would then mature after the stated time, at which point the insurer can either offer a new policy, or the policyholders can withdraw their funds along with the accumulated interest. So from this example, you see a few things here. First is that the maturity profile of the US annuities, being 3 to 10 years, is quite suitable for some of the private credit assets. Also, annuities tend to be viewed as very strong given they benefit from a strong rating of the insurer. This makes them very stable from the liability perspective. And final point is that higher rates on annuities tend to lead to better sales of the product. As private placements do offer about 80 basis points pickup versus public credit, anyone who uses the private placements, all else equal, can offer more compelling annuities.
I think a key theme to mention is that private placements also in liquid credit markets have been around for ages. So let's say you're an insurer and go to your investment bank and say, hey, I need, let's say, 7-year paper and want some additional pickup for that. And then the investment banker goes to, let's say, BMW or another high-rated credit and sources the paper there. And as an insurer, you get some pickup from that illiquidity premium. So it is a thing which has been around for ages.
Yes, certainly. And it's, it is not just about the product itself. We have discussed the concept of virtuous flywheel model last time and its benefits to the firm. But again, private equity firms can use their whole ecosystem to their advantage. By having access to that origination channel, they can structure assets more effectively to achieve their desired ratings, duration, and have visibility over the spreads that they can achieve. I can bring 2 anecdotes. One is a very recent one. I met a CEO of a large composite life insurer in Europe. We had a conversation about private credit because they actually do not have any, and I did ask, would you actually want to have some private credit to back your life insurance liabilities? And he said, yes, I would love to have some private credit, but it's not that easy. You want to have some control over the origination channel. You want to have some workout functions. It's not simple to get your teeth into it with 1-2 exposures. So that was one point. And a second point is when an insurer goes out and originates annuities, it will want to have certainty over its ability to source the assets. This applies globally, whether it applies to UK insurer that competes for a large bulk annuity buyout, or whether it applies to US annuity insurer. You will want to have some certainty what assets you can source at any given time. when you are controlling that supply channel, you are in a far better position to be able to predict that. And in my view, you'll be able to price it more effectively. So again, it's not just the product. You are right. Private placements have been around and are used by publicly listed insurers, but there are some additional advantages of controlling that asset supply channel.
So I think what you are saying is that if you, let's say, offer annuities at 7%, you want to be sure that you can originate at, let's say, 5%.
Exactly that. And you don't have that certainty at all times. I'll bring it a little bit closer home. We have seen, and talk about the UK life insurance market, we have seen cases where UK bulk annuity players are buying out pension obligations, and they are making certain assumptions around the assets that they will be able to source to back those policies. But initially, they are filling the investment buckets with gilts because there is not enough sufficient assets with sufficient yield to back those policies. So that is a real concern of firms. And once again, if you're controlling the supply channel of assets, you have much more flexibility in achieving the desired yield.
Another key differentiator is having a reinsurance business in-house. I think everybody can use reinsurance to offload unwanted liabilities, but having a reinsurance business in-house really helps to speed up the process and also think better about capital allocation.
Certainly, definitely. You can use different reinsurers, especially in the US, not just offshore, but you can also place policies in different states. We can go into this later, but certainly having a captive reinsurance business allows a better capital optimization at the group level. And it is worth just reiterating that all of this has come at a time when banks have pulled from some of the lending due to post-GFC regulations and left that unfilled gap that was met with capital from private credit originators.
I think that's one of the claims which is often made, that alternative asset managers and insurance are stepping in where banks have left a void. So filling that lending gap that regulation created post-GFC. I think that brings us to a very obvious question. What does asset quality actually look like on insurance books? And how much can we trust the disclosures and ratings?
Yes, you're touching a very, very important point. It's asset quality is certainly the main area of focus for private equity-owned insurers, and in fact, any life insurer. At this point, it's particularly with particular focus on private equity. At the end, going back to the idea of insurance spread products, losses from the investments represent the key risk to the business. I want to highlight a really important point here. It's critical to keep in mind that for insurance firms, it is not just about the default rates that people are focusing on, but more about the credibility of the asset ratings. In essence, the capital position of an insurer is a function of the regulatory requirements, which are determined by the ratings of the assets that the insurer holds. So you can have pressure on the regulatory capital ratios and the financial position already when large parts of the investment book are being downgraded, even in the absence of widespread defaults.
So what you are saying here is essentially that if you have, let's say, a loan book and the loan book is fine, so you have no defaults, but the regulator or also the rating agency wakes up and says, okay, this asset-backed finance portfolio doesn't look pristine, it's not a single A anymore, it's now a triple B. And that changes the amount of capital the insurer needs to hold against it, and also implies that the capital position of the insurer gets evaporated and needs to get filled out by future earnings over time.
The short answer is yes, but it's good to actually think about it through an example. If you take a portfolio of 1 billion in assets that, for simplicity, are rated, say, single A minus, the capital requirement on this book will be about 1% or $10 million. That's the $10 million of equity that an insurer will need to hold. Now imagine that this book is downgraded by 3 notches to triple B minus. The amount of capital to be held would more than double to $22 million. And as an insurer needs to hold about 2.2% against triple B minus assets. And you can make the stress test, you can take the stress test even further. Imagine a downgrade to double B minus. At that level, the capital requirement stands at 6%. So we haven't had any defaults yet, but the capital requirement has increased sixfold. You can clearly see how that can put pressure on the regulatory metrics of an insurance firm and weaken their credit ratings. But again, leaving this example aside, I think it's and talking back about the asset quality, I do think it's important to keep in mind that for the moment, looking at the ratings, we cannot categorically say that the ratings are deteriorating or that they are weak. Again, based on some disclosures, externally assessed ratings stand at over 90% at investment grade level category. And you can see also when you track the historical perspective that some of these ratings are actually improving. I was selectively looking at Global Atlantic and Athene because they provide detailed historical figures. Admittedly, it's not available for all those private equity insurers, but it does help us to get a glimpse into how the externally assessed ratings for the portfolios have improved over time. Now, that's just one perspective though. And I want to say that's where the good news ends. We can look at NAIC ratings. These are ratings which are based on the ratings from the nationally recognized rating agencies, but they are assigned by the Securities Valuation Office, which has authority to override them and challenge those external ratings. And they are also used for to calculate capital requirements for life insurers.
So a regulator could come in and say a rating from Kroll is not really fulfilling our standards, so it should not be a single A, it should be a triple B basically.
Yes, they have the authority to override those NAIC ratings, which crucially feed into the capital requirements.
But I guess it has been rarely done.
I do not think there is a way of actually verifying what's the percentage of ratings that have been changed by the regulator. Having said that, what we can do is we can look at the differences between the ratings being assigned by the externally rated rating agencies, and we can and those which have gone through the filter of the Securities Valuations Office. And when you look at the NAIC ratings over time, in fact, in case, say, of Global Atlantic, you can argue that there is some deterioration. Yes, majority of them, about 95, 94%, are still investment grade, but there is some deterioration, which you wouldn't see if you were to look only at the external rating agencies. So this does open up the question, first question, or one of the important questions around the credibility of those ratings. Which one should we look at?
So you're flagging that NAIC ratings are telling a different story than the headline investment grade numbers. Could you help listeners understand why that divergence matters so much? And could you also touch upon the rating shopping angle, including the SEC investigation into Egan-Jones, tells us about the credibility of the ratings underpinning these capital structures?
Sure. So back to the point that I just want to emphasize, the credibility of ratings is critical as it determines the insurer has sufficient capital. So with that in mind, we have to highlight that the ratings that are being used are indeed under some scrutiny. Or in other words, there is some potential evidence of rating shopping, which you can expect when you have about 10 external rating agencies. What we have seen in terms of tangible evidence, what we have seen is the SEC investigation that you alluded to into Egan-Jones and their practices in assigning private agency ratings. The FT has specifically pointed out or highlighted their large ratio of ratings being assigned by that rating agency to the number of analysts that they had. Separately, in their stability report, the IMF also highlights the growing use of specialized rating agencies and how that has grown massively since 2019. So all these things make you question the credibility of the ratings. Now, you can't categorically say that they are wrong, but it does make you ask those questions and wonder how credible are the ratings, and therefore how reliable are the capital requirements that are based off of those. And it's not just the ratings. When we're talking, the space is pretty opaque. So we are also trying to find different snippets of information to inform our judgment and our understanding of the asset quality. And somewhat anecdotal, but I think it's worth mentioning. A case of security benefits, so another private equity owned life insurer. Between second and third quarter, security benefit provided updated disclosure on its ABS holdings. They represent 40% of its asset allocation. In the Q2 update, this allocation was overwhelmingly classified as corporate exposure, very broad. As of the third quarter, the classification was changed and nearly half of the ABS portfolio was classified as private equity. Now, that's not exactly what you want to see on the balance sheet of a life insurer. So, again, when you look at the ratings, they look good, but there is an element of opacity about it. It's an element that makes you ask questions, adds uncertainty to the overall assessment, makes you nervous. Doesn't mean it's bad, but it's uncertain. The very final point, though, I wanted to make on asset quality. and that actually relates to the recent noise about BDCs, is that private credit in BDCs is different to that of life insurance firms. For start, BDCs tend to hold exposures which are rated closer to single B, whilst life insurers hold very little sub-IG investments, as we have just discussed. The stock of software loans is also minimal for life insurance firms, and that's in stark contrast to the BDCs. Again, I'm not saying all the software loans are bad, but since they were in the headlines, we're touching on this topic. And finally, BDCs are only in corporate lending, whilst life insurance firms would be extending private credit against different assets, be it in real estate, infrastructure, and so on. So, in other words, whilst opaque by nature, clearly less liquid, private markets have different pockets, and they will always sit with different investors. They'll just have different motivations for buying these securities.
Yeah, 100%. I think that the key takeaway here is that while at BDCs, where you have 100% quasi corporate lending, it will come down much more to defaults, whereas in the case of insurers, the key risk seems to be centered much more about downgrades and the treatment of the regulator. We have touched upon asset quality, ratings credibility, opacity. We have covered the asset side pretty thoroughly. Let's flip to liabilities. BDCs have shown that the funding side, especially on the equity side, can become unstable very quickly. What does the funding profile of these PE-owned insurers actually look like under pressure? And let's use this as a moment to properly address the funding agreement question, because I know you have very strong views on how that's been mischaracterized.
In order to get a better sense of where the funding risks lie, we could focus on the liability side of Athene Global as an example. About half of it consists of annuities that have some withdrawal fees, and a third cannot be surrendered. I think it's not a bad start, especially when you compare to other financial institutions. But still, I think it's good to consider the pros and cons of these liabilities. As we have seen with BDCs, as you mentioned, seemingly stable funding profile can become vulnerable pretty quickly. As you said, and given we actually started off with it, let's start with the funding agreements, just to get it out of the way. So, funding agreements are originated by the insurers as bonds, and they rank alongside, or are pari passu, policyholder liabilities, and they benefit from the high issuer ratings. They are distributed to institutional investors and are popular as they normally offer much more spread than other similarly rated public bonds would. In terms of their funding stability, these bonds have no acceleration clauses. They cannot be called up early by their holders. Their maturities are also termed out. And they're not some overnight or 6-month paper. As far as I'm concerned, the main risk here is that the spreads on these may widen during refinancing, making the carry trade less economical for the life insurer. So I think that puts, that sort of, as far as I'm concerned, that addresses the questions on funding agreements, at least from the funding stability side. But beyond this instrument, and probably even more importantly, we have the policies and the considerations around the policyholder behavior. specifically, are we going to see spikes in surrender rates? Or, in other words, are the policyholders going to be cashing out their policies and requesting their initial investments back? Why would they do that? Well, they would be nervous for whatever reason. It can be greater market volatility, it can be negative headlines around the sector, like we've seen with BDCs, or it can be issuer downgrades. Now, as mentioned before, annuities in most cases have withdrawal penalties to discourage early redemption. So this will provide already some protection from the stability perspective. At the same time, up to 10% of the principal of any annuity can be withdrawn penalty-free every year. So you could argue that this represents some risk to liquidity. There are also, however, state-level guarantees over the annuities and life insurance products. Average policy in the US stands at about $150,000, and the state-level guarantees are anywhere from $250,000 to $500,000. On the flip side, unlike banks, these are not funded, and they are only funded with sector contribution after the loss event happens. So there is arguably a touch more risk there. Now, it is also really important to just keep in mind that all insurers will keep liquid assets and facilities to meet possible requests for any redemptions. We talked about Athene. So as for Athene, they would have liquidity and facilities equal to about half of all their outstanding annuities.
So it seems that the risk of an insurance run is fairly contained, at least for the moment. But I think one thing we haven't touched upon is the regulatory side. And I suppose that is where most of the structural risks are hiding. You have mentioned offshore insurance and captive structures. Can you walk us through how that capital release mechanism actually works in practice and where it starts to look less like smart structuring and more like a problem waiting to happen?
Yes, spot on. Reinsurance practices have been very much in focus. First, before we go offshore and abroad, I would say that regulatory arbitrage can start with the US, within the US, just because US insurers are regulated at the state rather than federal level. And this leads to a situation where the life insurers can utilize different state requirements to transfer assets to subsidiaries in different states that have more favorable capital treatment. That said, large cessations do require approvals. The use of offshore jurisdictions, though, going back now to the offshore jurisdictions, the use of offshore jurisdictions has certainly been significant and has been on the rise. One of the statistics by Bank of International Settlement notes that about 40% of reserves have been ceded offshore. So, capital efficiency can be healthy, but there is always a risk that these practices will be pushed too far.
Does 40% mean that 40% of all of the insurance assets have been ceded offshore in the US?
40% of the liabilities have been ceded, and there were also some assets that have been ceded as part of this process, because increasingly what we are seeing is private equity-owned life insurers are using the so-called asset-intensive reinsurance. So in a standard reinsurance transaction, you have normally a much or a better rated firm and a better rated reinsurance firm that receives a fee for reinsuring a pool of liabilities. they're effectively leveraging their stronger financial position. And that's it. They take the reinsurance of the liabilities, they receive a fee. Done. In asset-based reinsurance, the insurer would transfer the liabilities to the reinsurer along with the assets that are backing them. And the return on these assets would effectively pay for the liability reinsurance. And this sort of transaction allows for significant release of capital to fund new assets.
So the reinsurer is basically betting that the asset he is acquiring are paying for the liabilities he has assumed.
Correct. Yes. And I'll give you an example here. I think it's always good to think of, it all appears more abstract. It's easier to think through some real world examples. Say we start with a block, a 1 billion annuity block. So this is $1 billion in assets, $950 million in reserves, $50 million in capital on the liability side. And we want to cede 90% of the block to the reinsurer. So we would reduce our reserves or liabilities by 90%, and the asset side would also be reduced by 90%. We would increase a counterparty risk charge as part of this process, and the exact figure of that counterparty risk charge would depend on the rating of the reinsurer, but at BBB, let's say, it would be 5%. So this leaves the insurer with an asset of $140 million and a total capital requirement of just $7 million. This transaction leads to a release of $43 million in capital and allows the insurer to acquire $860 million in new assets. And then you may ask, so what's the issue there? And the issue is that if that reinsurer fails, the original insurer will have to recapture both assets and liabilities, which would put immediate pressure on its capital position. In the UK, for instance, this practice of what's called funded reinsurance has been curtailed by the regulator, but it's still very much used in the US. And, as a final point to this, it's somewhat cynical, but even Apollo noted in their last investor update in December, I believe it was, that the regulatory arbitrage represents the most serious threat to the financial system. So I'll just leave it at that.
It seems that that regulatory arbitrage seem to be the most pressing risk for the moment. But if we bring it all together, if you had to rank where the first cracks appear in a genuine stress scenario, so let's say ratings pressure, reinsurance unwind, policy surrenders, or defaults, what's your hierarchy, and can you put any numbers around what a ratings migration scenario could actually mean for capital of the insurers?
So, big picture for me, the biggest risk is the possibility of rating downgrades triggering capital calls. I think there has been some evidence that ratings may require additional scrutiny, and small changes to assessments can lead to big differences in capital requirements. As we mentioned before, an asset moving from A- to BBB- can require double the amount of capital. Second biggest risk, in my view, relates to reinsurance. When you transfer 90% of liabilities and assets to a Bermuda or Cayman captive, you release capital, but you also concentrate counterparty risk. If that reinsurer stumbles, the cedent recaptures both assets and liabilities. And $43 3 million capital relief evaporates instantly. As Apollo flagged also, the regulatory arbitrage is the most serious threat to the financial system. Further than that, on the list, I probably would say that the increase in defaults, it is always a risk in a recession scenario, but the starting point for the ratings, even if they needed adjustments, is still rather high. So I'm not that worried about seeing widespread defaults in insurance books that benefit from 90% plus investment grade rated assets. And finally, I have to mention it, policy surrender, early termination, lapses, it is always a risk too. As we have learned with BDCs, the sentiment can change quickly, headlines can turn, and confidence can falter. Still, given the policy features, withdrawal fees, guarantee funds, liquidity buffers, at this point, I would consider this to be more of a tail risk.
It seems that the key risks are centered around regulatory issues. And it seems also that the 2008 comparisons keep coming up in the commentary, a time where banks also have been under-regulated. You're clearly not predicting imminent collapse, but what's your honest assessment of the structural echoes, and what are the 2 or 3 things you tell listeners to actually watch as leading indicators?
Yes, so I definitely want to be clear. This is not a prediction of an imminent collapse by having a discussion around the parallels to 2008. These firms are better capitalized than the shadow banks pre-2008. Policyholders have genuine protections. There is less leverage in the systems, and regulators are paying attention. They had the benefit of learning from pre-2008 mistakes. But again, there are structural echoes of 2008. Back then, we had non-bank intermediaries that stepped in when banks retreated from certain lending. They were funding long-term illiquid assets with short-term liabilities. And when the confidence broke, reconsolidation crushed their balance sheets. Obviously, AG, Lehman, Bear Stearns. The dynamic today is similar. PE-owned life insurers are filling a lending gap using annuities and offshore entities to optimize capital. If that confidence cracks due to ratings volatility, a major default, or a policy run, the unwind could be sudden. The key difference, though, is that US life insurers do have state guarantee funds and do have that regulatory oversight. This was not the case for shadow banking prior to the global financial crisis. That's the real backstop. Is it a silver bullet? Probably not. Guarantee funds are assessed post-insolvency. State silos still mean that the regulatory response is fragmented, and broad systemic stress would strain the system. So you ask, what do I watch? What do we watch? We follow the disclosures, and I think it's worth following the disclosures. Obviously, the NAIC rating trends, offshore reinsurance concentrations, and importantly, the surrender rate spikes. Are there any changes from the perspective of the customers? Do we see some trends that echo the experience of BDCs in the most recent past? I think you have to monitor rating actions closely, because downgrades hit capital faster than defaults. Do not wait for the defaults to happen. And just keep an eye also on interconnectedness. If private credit stress spills into the insurance sector or vice versa, this can have systemic consequences. So in one line, I would say that the US life insurance system, in my mind, is far from broken, and the current model has genuine economic logic. But it is built on a foundation of stable funding and credible asset ratings. And as we've already discussed, these assumptions can crack faster than headlines suggest.
Thank you so much for appearing on Fixed and Floating. It was great to have you on. Where can listeners find more of your work and see how you analyze credits?
We frequently communicate with our investors via our blog at 24 Asset Management website. So that's probably the best place where you can read and find our insights.
Jakub, thank you so much for coming on Fixed and Floating. Already looking forward to the next time you come on. And also thanks to everybody watching and listening. If you enjoyed this episode, please follow or subscribe.